Greetings, my name is Christopher Bell. I'm a certified public accountant. In this video, we're going to do some basic journal entries to account for investing in bonds. Now, I got two pictures here. On the left, I got Christopher Bell, that's me, and on the right, I have a treasury bond. So Christopher is a very rich man. You know, he bought Tesla stock in Bitcoin, and he made a ton of money, and now he wants to park the money somewhere safe. So he says, I'm going to put my money into a treasury bond issued by the United States government, and I'm going to collect interest payments and live off that for the rest of my life. So Christopher Bell decides to buy this treasury bond for $10 million. Let's go ahead and read the scenario and see how Christopher Bell could potentially account for this. Christopher Bell, me, purchases a $10 million par value government bond at 100 on November 1st, 2022. The bond matures in 5 years. The bond has a stated interest rate of 5% and pays interest semi-annually. Record the journal entries for December 31st, 2022, May 1st, 2023, and November 1st, 2023. Now let's analyze what happened here. So Chris, like I said, purchased a $10 million par value government bond at 100. That means that Chris paid exactly $10 million for the bond. This 100 here is used to represent differences in the par value of the bond versus its actual cost that you paid for it. So if you saw 101 here, you would actually be paying 101% of the stated or the par value of the bond. In this case, I paid par value on November 1st. The bond matures in 5 years. So how it works is Chris gives the government $10 million. The government gives Chris this piece of paper, theoretically. And then in 5 years, after Chris collects interest payments, he gets the $10 million back from the government. That's the basics of how a bond works. The bond has a stated interest rate of 5%. 5% means the annual rate, not the semi-annual rate, not the quarterly rate, the annual rate. If you want to calculate the semi-annual rate, you got to do it yourself. But when you see a rate attached to a bond, unless it says otherwise, assume it's an annual rate. And it pays interest semi-annually. That means you get interest twice a year. So let's go ahead and record the first journal entry. And we'll do a little bonus one. We're going to record the entry of Chris investing in the bond. So first, we debit investment in bonds. Why? Because it's Christopher Bell's investment. From his perspective, he's investing in the bond. He owns the bond. He's the holder of the bond. He's going to be collecting interest. To him, it's an investment. To the government, it's a debt or a liability. How did he buy the bond? Well, he paid cash. So you credit your asset, cash, and you reduce it by $10 million on your balance sheet. That's how you record the initial investment of a bond at par value. Next, we get to December 31st, 2022. So Chris is a calendar year taxpayer, and he's on the accrual basis of accounting because why not? So he has to record something, right? Because hasn't he earned interest revenue? Has time passed? Yes. Has he been paid interest revenue? No, because the first payment of interest revenue is not going to be until May. He's not going to get the cash until May of next year, but he has still earned the revenue. He has still earned interest. The question is, how much has he earned? Well, if we go up, we say, okay, it's a 5% bond on $10,000 paid semi-annually. So how many months have passed since the purchase? All of November and all of December. 2 months have passed. So to accrue, which means you just record something that you've earned or an expense you've incurred before you've paid the cash, the journal entry is you have to debit some kind of receivable because you have interest receivable, and you have to credit some kind of revenue. So let's go figure out how much Chris earned. So we have a $10 million bond that pays 5% annually. So the interest for the full year, the interest that Chris should be receiving for the full year is 10 million times 5% or $500,000 a year. Ooh, man, that would be nice now, wouldn't it? So Chris is getting $500,000 of interest revenue every year. How much has he earned? This is the annual amount. Well, 2 months have passed. So you have to take that $500,000 times 2 months that he's earned divided by 12 months. So Chris has earned $83,333.33 of interest revenue. Here's another way you can do this. Find the annual interest, $500,000, and divide it by 12. That's how much interest you should theoretically be earning every single month. And then you just take the number of months and multiply that by that. It's 2 months, so times 2. $83,333. So Chris is going to debit interest receivable because he hasn't been paid the interest. It pays semi-annually. $83,333. We'll just call it $83,333 because I don't like decimal points. So we're going to round it. So we have an interest receivable, a debit of $83,333, and then we have interest revenue for the same amount. Now, we go ahead and we hang out and we live our life and we eagerly anticipate receiving our interest payment on May 1st, 2023. So now it's time to receive our first interest payment from the government because it's a semi-annual bond. It pays semi-annually, aka twice a year. So how much cash are we getting for half a year? The full year is $500,000. So half the year is going to be $500,000 divided by 2, $250,000. Another way you could do it is you take the full year divided by 12 times 6. Boom, $250,000. So Chris is going to receive cash of $250,000. Now, do we credit interest revenue of $250,000? No, we don't, because we've already recorded 2 months of revenue in the prior year. So what we have to do is first remove this receivable. We have to credit out the receivable because we have collected the revenue. We've collected the cash. So now the receivable goes away. What was owed to us has been collected. Next, we have to credit something else, and guess what? It's 4 months of interest revenue. So if you take 500,000 times 500,000 divided by 12 times 4, you get 166,666. We'll call it 166,667. So we earned interest revenue. We'll just copy this. We've earned interest revenue of 166,667. Bada bing, bada boom. And if you add it together, it should balance. Let's double check. Plus 83,333.333. Okay, I was off by 1 cent, or 0.0000001 cent, but you see my point. So it balances. Okay, so we're good. So now we've removed the receivable. We've recorded our revenue. What do we do on November 1st, 2023? Well, 6 months has passed again. We get our next interest payment. So we go ahead and we collect our cash. But this time, since there's no receivable accrued, we're just going to straight up credit interest revenue for the full amount. Okay? That's literally it. That's the basics of bonds. You have to be careful. At every balance sheet date or every cutoff date, you have to record, if you're on the accrual basis of accounting, you have to accrue a receivable and a revenue or an expense or a payable. Because even though you haven't received the cash, you have earned the revenue. So hopefully that kind of makes sense. If you want a one-on-one session, you can always book one with me. There'll be a pinned comment down below. But that's the very basics of investing in bonds. And we will go into a lot more detail. Trust me on that. Talk to you later.